Have you ever stopped to think about the financial giant that's behind a huge piece of the U.S. housing market? Well, today we're pulling back the curtain on Fannie Mae's latest earnings report. And believe me, the numbers they just put up tell a really fascinating story. Let's get right into it. Okay, boom. Right off the bat, here's the headline number. $3.9 billion. That is the net income, the profit that Fannie Mae made in just the third quarter of 2025. And just to put that in perspective, that's a 16% jump from the quarter before. This one number, it's the key to understanding this whole story. But look, this isn't just about a massive profit number. It's easy to see that and just think, wow, that's a lot of money. But what it really represents is part of a much bigger story about the health, the stability, and, the future of the entire American housing market. It's a story that has incredible strength, but also some emerging stress. And to really get a sense of the scale we're talking about, check this out. Fannie Mae's total net worth has now ballooned to over $105 billion. This is their financial cushion. It's what allows them to be such a central player, keeping the market stable and moving. So the big question is, how does a company like this make almost $4 billion in profit in just 3 months? Well, the answer is deep inside their business model, in what I like to call the engine room, their guarantee business. So what is this guarantee business? Think of it like a giant insurance policy for mortgages. See, Fannie Mae doesn't give you the loan directly. What they do is they buy the mortgage from your bank, and then they charge a small fee to promise they'll cover the loss if someone can't pay. That little fee is the guarantee fee, and it's their absolute bread and butter. And this chart, wow, it really tells you everything you need to know about how important those fees are. A staggering 81% of their net revenue comes directly from those guarantee fees. It is the rock-solid, consistent foundation of their entire operation. Okay, now this is where the story starts to get a little more complex. Because that massive business isn't really one single market. It's actually two very different ones. First, let's talk about the bigger, stronger side of the business. Mortgages for single-family homes. The single-family business is, well, it's a behemoth. It makes up 87% of their whole operation. And right now, it looks incredibly healthy. The people getting new loans have strong credit. A full 80% of the new business is for people actually buying homes, not just refinancing. And most importantly, very few people are falling behind on their payments. The takeaway is simple. This part of the engine is running super smoothly. But, like I said, that's only one side of the coin. Now we have to look at the other side, multifamily properties. Think big apartment buildings. And this is where we're starting to see a few cracks appear in the foundation. This chart lays out the stress signals pretty clearly. You can see the bars here show that both seriously delinquent loans and something called net charge-offs are on the rise. A charge-off, by the way, is basically when the company has to admit it's probably not getting its money back and writes the loan off as a loss. Seeing both of these metrics go up is a definite warning sign. So let's just put it side by side. On the left, you've got the single-family market, which has a strong credit profile. And on the right, the multifamily market is facing sustained challenges. It really is a tale of two completely different markets right now. Okay, so we're talking about huge numbers and these interesting trends, but what does any of this actually mean for you, for homeowners, for renters, for anyone just trying to figure out the housing market? Let's connect all these corporate results back to the real world. This number right here, this shows the real-world impact. In just 3 months, Fannie Mae's work in the market helped over 400,000 households buy a home, refinance a mortgage, or rent a place to live. And get this, about half of the home buyers they helped were buying their very first home. This is why their financial health matters so much. It directly fuels what's possible for people. And hey, for anyone who already has a mortgage and is wondering if they'll ever get a chance to refinance, listen to this. This is a crucial piece of insight, and it's coming straight from the chief financial officer. She says, flat out, that they don't see a big wave of refinancing coming unless mortgage rates drop below 5%. That is a very, very clear benchmark for homeowners to keep an eye on. But there's one last really crucial catch to this whole success story. Even with all these profits, the company is still in what's called a capital deficit. The easiest way to think about it is this. After the 2008 financial crisis, regulators basically said, you need to have a much bigger rainy day fund, a huge safety net of cash to absorb losses if things go bad. Fannie Mae is using its profits to build up that fund, but they're just not there yet, and it's a key part of the puzzle for their long-term stability. So that's where we stand. Fannie Mae's core business is a stable, profit-making machine, and that is providing a really solid foundation for the housing market for single-family homes. But with those clear stress signals showing up in the apartment sector, it leaves us with a huge question. Is this just a small, contained issue in one part of the market, or is it a warning sign of broader troubles on the horizon? What's next for U.S. housing? Well, that's the question on everybody's mind.